Hello, Hamish here from mortgagesonline.co.nz. Monetary policy statement out from the Reserve Bank as they left the OCR unchanged at 0.25%. Some thoughts that they shared, some of it might have spooked some people and led them to believe that maybe they are thinking interest rate increases a lot sooner than later, and that may be the case, but key thing, what is it in there that has kind of led to this belief? Now, one of the big things that has been talked about is something which was left out for a little while because of COVID, and that was the OCR putting out the OCR projection. So this is where they kind of have a rate projection for what they think might happen with future increases, right? And in here, they left it out. And this is the first monetary policy statement, I think, since before COVID, where they've put it back in. And so here they've showed their cards a little bit, and they've said, look, we think maybe 2022, mid, late, it could go up. It could start to track up. Now, thing to remember about these projections with the Reserve Bank is this is by no means a target, okay? This is more of what they think is possible. There are a lot of variables, and any one of those variables changing can change the trajectory of the interest rates, right? And they're fairly clear on that. However, what things could change this, and what could make them increase interest rates? So let's have a think about that a little bit, because there are a few different things they look at. So obviously they have a target, and that target is around inflation, right? That was their main target. And that's supposed to be 2% sustainable over a mid of 2% now. That's the target, right? Now, it's already hit 1.5% inflation for the quarter of March, ending March. That could be due to, a lot of people think, just very transient or a spike due to supply chain issues due to control of coronavirus, right? Global supply chain issues. And you can kind of see that when you try to order stuff and it just doesn't show up. And there's a lot of people trying to bring forward orders and things to make sure they get it in time, and that actually puts more pressure on the supply chain. So a lot of that means there's a bit of a price spike, but it is transient, it's temporary, because if COVID and coronavirus is contained, and as supply chains and people are getting back to work, this actually goes away, right? So then the inflation, the true nature of what the inflation is, will be revealed, and it should dip, right? Now, that's one thing. So remember, the other target for the Reserve Bank is what they call maximum sustainable employment, right? And it's not defined by a single number here. So if you think about that, what they're talking about there is around unemployment, full employment. They look at wage growth and different things. Now, one thing to remember is that unemployment is actually lower than what we expected. However, it's patchy, and they mention this in their statement, that seems obviously the construction sector is very busy, but tourism is a scary place right now, and that we don't know how long they could carry on for, right? Okay, you have a bubble with Australia that looks good for a bit, but then anything can kind of jeopardize that. So there is a lot of ifs and buts. Right, so that's another target, maximum sustainable employment. And of course, now they also have to consider house prices, okay? Now, that is where obviously I have a bit more interest, is in house prices and how do they look. So a couple of things are on the horizon which may mean that they don't need the interest rate to hold back house prices, right? Obviously, they have other bits of tools, other tools in their toolkit, like the deposit requirement for investors, right? That 40% just kicked in, so that should feed through. The tax changes from the government side, the Reserve Bank is still yet to see what that really means as well. That's going to feed through. And let's not forget low immigration. As much as people like to have this, I even have this chat in the gym or sauna about all the New Zealanders coming back. Well, the truth is, if you actually look at the immigration figures, right, it's way down, even with all those people coming back. And this little spot down here, the grey area, is the real increase, the quarterly increase lately. And as you can see, compared to a very, much of history, it is quite low right now. Okay, that's just a fact. So there are other things that will take pressure off house prices, quite possibly, and so that's more of a wait and watch. I guess the thing to remember is, could interest rates? I guess the big question is, could interest rates go up? And the answer is, of course they can. And the Central Bank of New Zealand has a lot of control over the interest rate, but not full control. Remember, there is also a lot of things going all throughout the globe which has an impact. We've already seen that as the longer term rates, 3 to 5 year rates, have crept up a little bit lately anyway. Now, the other key thing to remember is that what the Reserve Bank has stressed, and they always do, is that they may have to be, even though they see some very good things ahead, which might mean that they start to increase interest rates. The key thing there is that they're going to be obviously patient, right? So what they mentioned is that the members reinforced their preference to maintain the current level of monetary stimulus until they were confident that the inflation and employment objectives would be met. They agreed this would require considerable time and patience, and I think that is an important thing to remember, in that the Reserve Bank kind of works almost like a counterbalance to the economy, right? So their goal really is to make sure that things don't really turn to custard. I don't remember, inflation means prices going up of goods and services, but it also means that incomes go up as well, right? That is a thing, although sometimes it feels like it isn't. Consider your starter wages and over the last 5-7 years in a lot of industries compared to 20 years ago, right? So you wouldn't, if you are looking at a home loan and you're thinking, geez, you know what, if this rate wasn't 2%, if it was 3% or 4%, I would really struggle. Then you got to really think about whether a home loan is the right thing for you. Because, I know if you've done a home loan with me, I always work things out at a slightly higher interest rate anyway, and we kind of average it. And I think that, the banks have been doing this for quite a while now. They are using a much higher rate, right? So they're still off, some of them are still working off high sixes, to work out whether you can afford something. So there is a bit of fat there before everything turns to custard, if interest rates were to go up. But I don't expect the Reserve Bank to push interest rates up while there was real problem in the economy, if you didn't have good pay rises, if you didn't have work, and house prices were crashing. I wouldn't expect interest rates to be going up at the same time. So that's another reality we've seen time and time again. So hey, look, hopefully that has been handy. It's kind of it's kind of interesting to unpack these things from time to time. But hopefully you have a good evening or morning or whatever it is now.